Thank you so much, Dave, and good afternoon, everybody. Always a thrill to be with you here in these Festival of Traders events. So much great content, and really just one great idea can make it so many times worth your while. We're going to talk today about whether you got a small account or a big account, how you can trade any size account, including a small account with $1 options. It's one of those markets where you've seen tremendous volatility. Obviously, we're just ahead of the election here, and I would expect plenty more volatility regardless of the outcomes. I think you've got a lot of outcomes that can be positive for the market, but I also think you've got outcomes that could be kind of like 2000, could be short-term negatives in the market. So my goal for you is to learn how to trade the market either way with these cheaper options. So just a reminder that everything that I'm sharing with you is for your information and education only here. Nothing should be considered a specific recommendation in today's talk. Ultimately, of course, that you are 100% responsible for your own investment decisions. Big Trends and the staff are not responsible for trades you choose to make. In the Big Trends, we don't provide personalized financial, tax, or legal advice to any individual. What we do instead is we take our research and we call it out through real-time emails and text alerts to our subscribers' smartphone. And that's what I'm going to talk to you about, is how I do this with a baseball theme called Grand Slam options today. Now, we just finished the World Series. Congratulations, all you LA Dodgers fans out there. It's been a long wait since '88, right? But basically, I'm in Kentucky, so we don't have a whole lot of pro baseball near me. We're all about basketball. I'm glad that'll be coming soon. But bottom line is that, regardless, baseball, most people think about getting onto first base, getting a single. We're not interested in just the little hits, the little trends. We're interested in the bigger trends here and getting at least a double in the baseball terms. Double in investing terms, is 100% on your money. If I can get, or when I get, because it happens reasonably enough, not every trade, of course, but it happens with enough regularity that when it happens, I want to sell half of my investment at a double and then get what's called the free trade. Get your original risk capital back in your pocket, and that frees you psychologically as well as financially to give yourself a chance to go for bigger gains. I think what's happening in today's markets is that so many people have so much what I call scar tissue, and all the traders I coach is saying, look, your past mistakes are causing you to miss 100, 200%, and even our home run potential 300% type of opportunities, because you can't accept that when you get a 20 or 30% gain, you shouldn't just take it off the table because you've been burned before, you've made mistakes before, you think I better book a profit while I've got it. In my experience, when I'm right, I'm really right fairly quickly. If I'm wrong, I tend to be wrong quickly enough, right? It's like one of those things where the markets are giving us constant validation. When you're right, you need to get more out of your good trades. When you're wrong, you need to be more impatient and get rid of your non-performers quicker. So we're going to talk about that. And when we talk about these options at $1 or less, that means it's $1 controlling 100 shares. You have to multiply out times 100 to say, okay, to control 100 shares of stock on one contract could cost you $100 or less with this approach. Now, based on what I'm advocating, selling half at a double, another half at a triple, and the final one at a quadruple, when we get those big winners, those Grand Slam, clear the basis kind of trades, that needs at least 4 contracts. So you can start the strategy with as little as $400 a trade, the way I'm teaching it to you here. Now, why should you care? Again, past performance doesn't guarantee future results. We know that. But if you looked at all of our trades since the beginning of 2017 on a model $10,000 portfolio, it'd be up to $33,500 before commissions. And as you know, these days, commissions on options are next to nothing. It's been a phenomenal environment to trade with a huge cut in commissions. I've been trading since 1990. I remember back when I graduated from Duke University and got started trading and thought $50 to do an options trade, even on a few contracts, that's pretty pricey. Right now, it's a matter of pennies per contract. Really tremendous. So you've got the potential here to see your portfolio go up by multiples as well. So let's talk about an overview of what we want to talk about here is indicators that help me to see when something's going into one of these big trends, really home run Grand Slam profiles. Now, the first thing that I'd look at here, this is Advanced Micro Devices, AMD, back in the summer. And you see here that basically, here's an example where everything was setting up here. We're going to talk about these 3 lines here on the chart. 2 of the 3 really were setting up, not all 3. They weren't confirming here. So that's a big X, a big no trade. It's not getting outside of that critical zone here. We're getting 2 of the 3 setting up again here with what we call the CCI and the percent R. We'll talk about these indicators in a minute, confirmed by the ADX. Some of you may have heard that here. And so we're saying, okay, we want to be on board this thing here on AMD. Right before it launches, those next couple of days, it went up 100 and 200% the following day and 300% on the second trading day after we got in late July. Now you notice here that when we bought this thing, it was trading in the neighborhood of about 62 bucks. We bought it on a 75, right to buy a 75 call means we got a right to buy the stock at a price of 75 bucks. Why on earth would you have a right to buy something at 75 when it's down? You could buy it right now at 62, because that right to buy the stock gets more and more valuable as the stock goes up. So as it went from 62 to 72 here, that 10-point move plus 10 points here, that's what, maybe a 15% gain in the stock, was good for ultimately plus 300% gain on our final piece. That's like a 30 to 1 leverage here, so, or at least a 20 to 1 leverage, I should say. So bottom line is that, the leverage potential is there. Now, when I think of baseball analogies in trading, I think obviously baseball icons and home runs would be Babe Ruth, right? He led the league in home runs, and that 714 career home runs record stood until the mid 70s. I remember watching Hank Aaron hit his 715th for the Braves back there with my dad in the 70s, and truly just like lights flashing and everybody realizing what a momentous accomplishment that was. Well, the bottom line is that the Babe, for all his home runs, had almost twice as many strikeouts. And this is something that I think is the worst 4-letter word out there, is FEAR, fear. It's worse than the other expletives that you hear about, because bottom line is that fear is what's holding so many people back from achieving your true potential, from achieving your investment goals, your goals. Say that you've been looking to get into trading for a living, or you've been looking to take another business opportunity and really tackle it. You can't have that fear holding you back. That's like an anchor that's going to weigh you down. You've got to be able to say, how can you start to learn how to trade without such a fear? And what I always tell people is, you've got to start small and build. That's why I talk about how to trade a small account first before you talk about how to trade a medium and then a large account, because you've got to build that confidence one brick at a time. And this is your trading foundation we're talking about. And like I said, so many people have had so many past mistakes that they're basically stuck in a fear mode. And I know a lot of you would acknowledge that. I don't have a lot of time to get into a lot of Q&A here, but I'm going to just kind of, hopefully some of these concepts resonate with you. I've been trading myself for 30 years and launched Big Trends 21 years ago. This month, actually, November of 1999. So bottom line is that, what I like to remind people of is, even if the market tanks again, which it will at some point, let's face it, it will. I'm not making prognostications about will it tank after the election, will it rise after the election. I believe you've got to stay flexible. You've got to adapt to what the market is showing you the opportunity is. In March of this year, during the pandemic's worst declines for stocks, where the S&P got cut about 25 or 30% off of its mid-February high to the March 23rd low, we were actually making money not just on put options, but actually even more money we were making on call options, bullish bets on names like Kroger. Where Kroger set up here, we're going to talk more about these indicators. Everything was all set up, all systems go here at the close of this bar. We bought it this next morning at 31 bucks here on March the 5th. So this is just like taking from one of our model portfolio track records. That same day, it went up about a double. We ended up taking out a 91.5% that same day for a one-day move in the out-of-the-money 33 strike call. Now notice, stock was 31, then it went to 34. So the 33 call started 2 points out of the money. That is, got a right to buy at 33. Well, hey, the stock's already down there at 31, but then it goes from out of the money to in the money at 34 by the end of the day. That surge from out of the money to in the money is where you make the most money in these options purchases. It's called the gamma effect. We're going to talk about gamma. Now, I thought maybe we could go on to our next targets, and then the next day, look what happened. It popped down instead. So we sold the second half out the next day at only up 10% on the second half of our position. So we have some rules about trailing stops. When you become a subscriber, we give you all those rules in a fact sheet that's very concise but very important to basically follow along for you home gamers and know exactly what we're doing on all of these trades. Now, bottom line here is that we came back to the well. You see, it went down for a few days, started to come back up, and here everything's starting to set up again here. At the close of this bar, we say you got to get in here this next morning into Kroger. Again, the stock is now trading here about 32. The option's gotten a little more expensive. We have to buy a 38 strike call, but for a buck, that next day we're able to say take that stock, goes from 32 up here to about 36, about a 10% rally again in the stock. And notice we're getting our double. And I noticed that it's losing momentum intraday that second day. So here it is from the 17th. We got in on St. Patty's Day. The day after, we're going, you know what? I don't like what I'm seeing here after that morning surge, and I'm not going to let all that profit slip away. We took the second half out up at 92%. So I would have loved to have run for 200 and 300% gains, but the market wasn't showing me and the stock wasn't showing me what I needed to see, and I've missed that, and my subscribers at Grand Slam Options missed that whole give back of profits and see profits turn into losses. We didn't let that happen. So proactivity is very important here. We're going to get into some indicators and get into some more chart patterns of what success looks like, because I always like to say the names will change, the underlying stock names will change to have the right Grand Slam patterns, but the patterns remain the same, that these patterns repeat again and again and again. So like commodity channel index, we're trading stock options. Why would we use an indicator called the commodity channel index developed by Donald Lambert at the start of the 80s? Because it works on, especially on growth stocks on the way up and the way down. The reason that CCI is so effective, if you go and study it, is that it doesn't just look at closes averaged out over time. It looks at highs plus lows plus closes divided by 3 to get what Lambert called a typical price. And you know, if you're closing at the high day after day, that's going to give you a lot of positive momentum. If you're closing at the low, that's negative momentum. And what you'll learn from me here that's probably very different. I've got a lot of things I think are very unconventional wisdom, learned over 30 years of options trading experience, and early on the school of hard knocks, frankly, thinking I knew more than the market, and changing from a fundamental perspective as my lead to a technical chart-driven perspective to say, you know what? Let's face it, you and I as individuals do not drive the market. Whether you're trading $10,000 or 10 million bucks, we're all relatively small fish in this broader institutional pond that's trading billions of dollars per institution on these big boys and girls that are driving the market and these stocks up and down. And let's face it, they want to make money just like you and I do, but they can't rush all in all at one moment to buy millions of dollars worth or millions of shares worth of stock and splash all the water out of the pool. They try to ease in or ease out. So that means overbought when they start buying, and the pattern sets up here, they want to keep buying. That's actually a very bullish thing. It means that they want to keep buying when you see this pattern. And oversold can be really bearish on the downside. They want to get out, but they can't just rush out at once. So here's an example on that Barrick Gold, GOLD. To me, when you think about likely beneficiaries, regardless of who wins and however long it takes to determine the presidential winner, it's pretty much assured that both of them are going to continue to spend out the wazoo and lead this governmental effort to help get us not only out of the pandemic, but then out of the economic funk that has been kind of masked by all these stimulus moves. And they want to keep propping up the economy and keep flooding money at the market. Trillions of dollars of stimulus talked about at a time, right? It's beyond unheard of. And the reality is, you start to question, well, what are your dollars and my dollars going to be worth down the line? We can pontificate on that, but the bottom line is that I think the best bet sector is going to be gold and gold shares, stocks of names like Barrick Gold for the long haul. But that doesn't necessarily help us if we buy a short-term option. We've got to catch the timing right, okay? So you should be watching names like Barrick. But the key is you see the first attempt here where it starts to go overbought on percent R. We'll talk about that next. CCI is in this blue and yellow line, and it's not confirming. It's not getting going through that resistance. It's failing. And if you buy up there, you buy what I call a fake out rather than a breakout. It's not only frustrating, it's very damaging, not just financially, but psychologically, because then you say, okay, fool me once, shame on you. Fool me twice, shame on me. So you see this thing setting up again, you say, oh no, I'll bet against this move because that last one went back down. This one will probably go back down too. Big mistake. When it closes above that setup bar there, and you see the ADX, the bottom green line here is what's called the average directional movement. We'll talk about that one in a minute too. Bottom line is when all these things are set up and ready to go, we know we need to be on this train. The institutions are piling on here, and your job is to get a piece of that move. You don't have to catch it at the exact low. You've got to forget about that it was at 18 2 weeks before and say, you know what, it's up here just under 20 right now. We're buying a 20 strike call just slightly out of the money. And look what we're paying, 59 cents. That's 59 bucks to control 100 shares of Barrick Gold. It would cost you about $2,000. So you can see control $2,000 worth of stock for about 60 bucks. That's like, you can see the leverage potential there, about 3% of the cost of the stock, about 33 to 1 leverage potentially. And you can see that as the stock starts to surge here, those numbers start to actually add up. We get our double the next day, so it goes from 20 to 19 and 3/4 to 21. And then you see it takes a few more days, and then we walk in on the following Monday morning, and it's already up, gapping open here at 22.5. Stock's gone up a little over 10%, and our final piece of our option is averaged out at a 289% gain. So almost a 300% gain versus the just over 10% gain. We're in that 25 plus times leverage on that underlying instrument. So we don't have to have massive mega leverage, but we can still get this kind of big surge in profit potential in a matter of 4 trading days here. So it's very powerful when you see these all line up, and like multiple rivers flowing in the same direction in your favor will lead to a much greater opportunity and greater probability of success. So ADX stands for average directional movement. Wells Wilder, same guy that developed the RSI indicator, also developed the ADX and said, you know what, he wanted a trending indicator. Says, you know what, show me the net new highs, what's called DMI plus, the net new lows. If you're getting more new highs, the DMI plus is rising. You're getting less new lows, the DMI minus is going down. Guess what that's called? An uptrend, where we're going, you can see, this way, and it's a matter of just getting a piece of that move here. If it's going the other way, negative direction movement is going up, and the positive direction movement is going down, that would be a downtrend, right? So you're going down there. Okay, so the key is, okay, you want to get that trend right and really catch it in that sweet spot area. So an interesting pandemic name here, AstraZeneca, AZN. This was back in July, where we were saying it's just dead money for a while here. And then all of a sudden it starts to surge outside of what we call our big trends bands that I developed. That's another way to visualize when we're going overbought on an indicator like Larry Williams percent range or percent R indicator. Notice our ADX here is just starting to upturn here. So ADX is exactly where we want to be to say, how many times have you seen a trend, a no trend, folks, where you shouldn't have been trading through all the hype and all the COVID news and everything else, saying, you know what, it's not there yet, but you're trying to take a flyer, you're trying to buy a dip, catch a bounce, hope you can get a little piece. And you go, you know what, you get chopped up through all that sideways action, and then you're not ready to take advantage. You've lost interest or you've gotten burned, and now you're saying, no thanks, I'm not going to try to take advantage. We were saying, you know what, now is exactly the time as it breaking out to get on board. And again, the stock's trading here about 58 bucks. We're buying a 65 strike call. Notice where we're buying it. These are all monthly options. We're going out to the 3rd Friday in August as of about the middle of July. So about a month or 5 weeks away from the August expiration. Notice what we paid to go with it more than 10% out of the money. We're paying 83 cents or 83 bucks to control 100 shares worth of stock. We got that double and that triple, 201% on the second day in the trade. And then over the weekend, they announced from the 17th to the morning of the 20th, that Monday morning, that's where we sold out our last piece, plus 357%, as they announced good news on their initial trial. And we said, you know what, buy the rumor, sell the news. We're cashing it in and saying, thank you very much, take the money and run, as it then came back down. So it's all about catching that. It's fun when you see subscribers that are fairly new, like Tim Q saying, great AZN trade in the Grand Slam last Friday, kudos. You know, so it's a lot of fun to see subscribers start to catch this big trends bug, if you will, of saying, I'm tired of this little fish approach. I can get there a lot quicker if I'm patient and I wait for these setups and then take advantage of them when these signals fire. And then the big trends bands is another way to see these power trends. And this is inspired off a Larry Williams indicator called the percent R or percent range indicator. Now, percent R says, where is the stock trading within its whatever look back period you want to look at? The last 20 days would be the last month, what have you. And so you look back and say, okay, if we're trading the high of the last 20 days, we're going to be at the peak reading. Larry called it a zero number. I call it a plus 100 number because, you know, it's the highest it could be in that range. But you know what? If something's at the high of its range, but it keeps going up, is that really a range anymore? Heck no, it's a trend. So when it comes out of that, that 80-20 area, and that's what I define my big trends bands as, the 80 percentile level and the 20 percentile level, because what I found is that the top 20% of these moves is where I get 80% or more of my trading profits. It's a modification of that centuries old doctrine called Pareto's principle. I'm sure a lot of you have heard of it, more recently called the 80-20 rule, which just says, hey, 80% of your results come from 20% of your actions. 80% of your customers, 80% of your profits come from 20% of your customers. 80% of whatever you're doing out there is going to come from 20% of your behaviors in that particular area. It's just an amazing factor. And, really, this has also been kind of the multiplier effect of Pareto knows the top 20% of people had 80% of the wealth. Guess what? As those people keep expanding their wealth, we've gotten into this top 1% controlling an amazing amount of wealth, right? It's because the successful folks keep doing what's successful, the unsuccessful folks keep doing what's not, and basically that pattern just keeps on multiplying to your benefit, or if you're making mistakes in your trading, to your detriment. So you have to be able to change your philosophy here, and that's all I ask is try with a small amount of money, even paper traded at first with a special trial I'm going to give you at the end to say, what, try it out for 30 days. Just watch what you've been missing and see how powerful this can be. Overbought can stay very overbought, and you've been missing those because you've been mistrained on what overbought means. So when you add all the indicators up, you see overbought percent R, very bullish. And someone said to me, oh, well, it went on even further. You left money on the table. I'm like, yes, I did. And if I get 100, 200, 300% in 4 trading days, I don't care. I'm happy to book those profits, take the money, and run. You've seen other examples where it was smart to do that, and then they came back. Some of them do keep going. Some of them don't. But you know what? We're catching what I call the sweet spot. Notice the CCI really accelerating right into this phase here in that overbought zone, and ADX going vertical in the green line and not bending. It's continuing to go up. Another Baidu example, this one was a little slower to develop. We're in or coming out of earnings season here, as we've gotten a lot of earnings reports under our belt. This first earnings gap up happened, but we weren't quite there yet. The ADX was just starting to get ready here to go right at the day after that, but percent R was still coming on board here, and then CCI came on board last. I need all these indicators to come together. Notice where they're coming together right as we come out of this triangle pattern that's consolidating, catching its breath after the earnings. Notice you see the stock's holding up pretty well off those lows, but it takes a while. Guess what's happening with those option premiums while the stock's going flat right after earnings? They are collapsing. But as we pick it up on the next wave, as it starts to get ready to trend here, in 6 trading days, we're getting our 100, 200, 300% gains, saying thank you very much. Again, look at the pattern. It's staying overbought. Now, here's a great example where you say a couple of days later, gee, price, you should have held on. It went even higher. And you know what? You might be right. But if you keep being greedy like that, you see that after 4 days later, you'd be hating it that you held on. You'd be turning a winner into a loser after 5 days. And you'd really be kicking yourself all the way home. We don't want that. We want to just catch that window, take advantage of it, move on to the next opportunity. It's all risk reward, folks. And when your risk is increasing and your reward is diminishing, you've got to realize, okay, there's a time to ring the register and a time to go on these trades. Now, when I launched Big Trends in '99, I was all about high delta. Because I was like, hey, I've got my funds and I'm trading here in the market, and I'm trying to make sure I've got enough money to launch bigtrends.com and make sure that I've got enough money to survive a potential couple of year bear market. You're thinking bear market in '99, what was he thinking about? Well, I got featured in Barron's in September 2000, less than a year after I launched the company. I said, watch out below, the market's headed for a big fall. And those next couple of years were pretty rough as the index dropped about 50% on the S&P from its peak to trough. The NASDAQ even worse, because let's face it, we had just an incredible bubble in tech that had to be popped. A lot of people have called this market a bubble. I don't think we're at that point right now. You could say that maybe in the FANG stocks we got there a little bit, but basically there's enough other skepticism out there that it's not the same as '99 in my view right now. We'll see, but basically, bottom line is that regardless, there's a lot of money to be made, the upside and the downside to come. The key is when you're buying options, you do have to be aware of theta, which is how much time is eroding on your position. We're going to talk about theta, but how my approach has evolved here is to say, you know what, gamma is where you can really score your best returns buying options in short periods of time. Like that Kroger example I showed you where we went from out of the money to in the money, that's how fast you will pick up deltas. When you pick up deltas fast, that's where you're getting that leverage effect of the option really kicking into gear. So when we say, if you're at the money option, that's a 50% delta, saying, okay, the stock moves a point in your favor, that option should move up 50% of that. Well, in this case, we start with an out of the money option, might have a 30 or 35% delta. Then as it goes to at the money, it's got a 50%. Then as it goes to in the money, it's got a 60 or 70% delta. That's where every point is truly multiplying your profits greater and greater. And here's an interesting example too with Morgan Stanley. And this is where we're going to get into our time stop rule. When I put out a trade, I don't put a price stop initially in the first 5 trading days, because I've learned that you've got to give these more aggressive options a chance to move and not get whipsawed by a brief little adverse move against you. Here's Morgan Stanley. You'd say that's not your classic tech stock big mover, right? Well, guess what? All systems were go here when it closed above this breakout level here this next day. And notice, as I'm buying in here right off of this open here, I'll put a B on that for a buy. I am wrong initially. Guess what? Not all examples I show you are going to be perfect straight up examples. Sometimes in the real world, you have to endure losses, or at least you have to endure, in addition to the occasional losses, you've got to endure waiting times. You've got to endure, okay, it didn't fire right away. It needed to cool off a little bit. If you count it out here, 1, 2, 3, 4, on the 5th day, we're back to right about or just a hair above where we got into that trade. It is on the 5th day, I want to be profitable. If I'm flat or against me on this underlying stock, I need to blow that trade out. But guess what? You can see here in the 6th day, it's continuing to go up. 7th day, it gaps up to about 51 bucks. And we're actually going in reverse here, because we got our first piece at 247% on the 7th day, 224% on the next piece, and our trailing stops hit at 146% on the rest. It added up to more than our typical winning trade because of that big gap. But guess what? If you had a 50% stop loss out there, you'd be knocked out in day 1 or 2. You'd be down 50 instead of up to 20. That's a 270 percentage point swing. That is a huge reason why I don't like to just use a price stop and then get whipsawed out of an otherwise good structured trade. Because notice, even as like the percent came in for what I call a retest here, that retest pretty much held right there that next day and then ground back up. It took a few days for it to get back to where it was. So you say, so how you manage the time decay curve? Because obviously, if you're heading into an expiration example here and you say, look, with this trade, 0 days is the expiration. The last 30 days, you lose about 2/3 of that option's value on a 4-month option. But what I've noticed is somewhere in the about 4 to 6 weeks out before expiration window, you can take a 5-day sliver of time decay and say, you know what, you can make that up pretty quickly if you catch these speed moves that I'm showing you here. So whether it's a breakout or what I call a retest, give it a chance in 5 days, and I think you'll find buying a 1 month or more option, that 5 days is manageable to say get rid of it if it's not working. Here's a great example with Zoom. Zoom videos, is kind of the poster child for the pandemic winner. And you can see we're coming off what we call a retest here. That was a CCI retest. A couple days later, it's testing back into that. It's holding our big trends band support. We're saying, look, this is a great time to get a good low risk trade on Zoom. Now, it wasn't cheap. Stock trading 115. We got to buy a 200 strike call going out to mid-May. And you're going, wow, 5 weeks out, you got to buy like 85 points out of the money. But look, over those next 5 days, look what the stock did. It went from 115 to 150. That move was good for 100 and 200%, 101 and 200% in 5 days. On the 6th day, it stalled and started to roll over, and we blew out the final quarter up 117%. And regardless of what happens at that point, you're saying, hey, that's a nice trade in a total of 7 days. So the point being that you can take advantage of this. One of the other interesting things I do to factor in time into my options trading is I don't just look at a stock chart. I also look at what I call an option chart, which is just a price chart of the option. You say, even well-known option strategists out there will say, why bother? It's just a derivative of the stock. Because you know what? A time element is so critical for an option versus a stock. If you buy Apple stock, it's going to be here for many, many decades, if not lifetimes. If you buy Apple 1 month calls, you've got 30 days to see things prove out in your favor. If you buy right in front of big volatility, right in front of earnings, you've really got to overcome a lot of potential volatility. We don't really use this strategy for earnings except for this one example I'm going to show you here. This was an example of Microsoft in the past where Microsoft's blasting to the upside. All systems go here. This is a ways back here, but you can see the stock's 77 bucks. We're buying an 80 call, again, about 5% out of the money. We only paid 55 cents for those options, 55 bucks a contract. And we got a double in about 6 days. And you see right before earnings, it's just pausing here for about 4 sessions right after we got our double. You say, well, you know what? I'm going to roll the bones on this and go ahead and take a shot at hitting the upside score, because all systems are still go on the upside here. Everything's still trending up. It gapped up 5 points, made 756%. And when you look at the option that we actually purchased at the time, the November 80 call, this was one where it was interestingly just getting blasting off here, even right in front of that earnings period here. You can see percent R going over bought, CCI over bought, ADX starting to trend up here. the green line. So all trends are up on the options chart as well as the stock chart. That option the day before the earnings finished at about $1.10. We sold it out that next morning at 471. So that was a huge example where the options chart can really guide you that you've got something work in your favor. Let it keep working in your favor, especially when you can get your free trade before the earnings report. A lot of the big tech names, in addition to like financial technology, Visa, MasterCard, of course, we've added in Square and PayPal more recently. You see just a lot of the big name tech on here, casino stocks, whatever's got a growth bias to it, we're going to try to trade. Some names like Tesla, frankly, have gotten too hard to trade because the options are way too expensive to find a $1 option. In my opinion, you got to go way too far out of the money. I will never say never on those, but I'll say you'll see us trading names like this, like Mylan, generic drug stock. You say that's not my typical wild and crazy tech stock. You see, the longer the base, the bigger the breakout. Mylan going sideways for quite a while, then everything starts to set up. This is a Thinkorswim chart. My other charts I showed you are TradeStation charts. Regardless of what platform you use to trade it on, we're saying, hey, all systems go right here. We're buying this next morning here, and we're initially wrong that first day, but the second day and beyond, we're right. This will take a little longer to get our 13 days to get our 300% gain, but you know what? In just under 3 weeks, that's fine. If it's working for us, we'll ride it. We just don't like to hold with less than 2 weeks to go before the expiration. So that's where I will blow out a trade, even if it's working for me. Don't hang on in the last 2 weeks of an expiration. Go ahead and roll on out to the next opportunity. So it's all about getting this gamma booster strategy going from out of the money in the money is where you make your most money buying options. I know a lot of people are very risk averse to even thinking about buying an option. You want to do an option spread strategy. You could use these names to do spreads, but you'd be limiting your profit potential. I say set aside a small piece of money, trade this strategy in the dedicated way that I teach you, find the true outliers, and you get the best bang for your buck on these straight option purchases costing $100 or less per contract. We now have more than 50 stocks that fit this profile. Sometimes you've got to wait for months for the breakout to happen. This is why it's so important here. This was actually a resistance level here, $68 on Schlumberger, and it was at the start of a new year that it finally broke out after months of going sideways. And all systems are go once we cross through this first resistance here. I'll put an R on it. It took like a week after that to get going, but finally did it right here. We bought that next morning right in here, and we said, look, from about $69, we bought the 72.5 calls. It went from $1 ultimately to $4 in 5 trading days. And look at how vertical it is. It's like now the institutions are just piling on. You'll see this so much where you say, look back at a chart, and you see months where not much happened, and then bam, in a matter of days, if not a week or two, you've got like a year's worth of movement sometimes, right? And it's just fun when you get the feedback, like Srikant said, and he said, great start, great feeling to start the service with a winner. We always want that for all of our new subscribers. I can't guarantee that, but it's fun. And he said, after trying many different services and them not delivering, it's fun when you see people start to catch the grand slam options bug as well. Remember what I said too about bases. Here's a different kind of a base. You probably heard about this one. It's what Investors Business Daily we call the old cup and handle breakout, right? You've got a cup forming here. You see we buy as it comes off of that cup, and then we have to endure a little bit of a handle here, frankly. There's a little handle pattern there, right? And remember, you count out 1, 2, 3, 4, 5, and you see by the third day we're profitable. The first couple we weren't. We might have gotten whipped if we weren't careful, but you see by the 5th day we're profitable. 7th day we're cashing it in at all of our target profits. And I've even got an intraday chart here that shows you, you know what, everything I'm teaching you on a daily chart, which is what our Grand Slam patterns are truly based on, can be applied on an intraday chart. This is a 30-minute chart. You can see on a Thinkorswim chart, CCI on the bottom, percent R. Those are firing here. ADX is not quite as good as I would like it there, but look, ADX really firing the 7th day we're in that trade. You see the percent R overbought. You see the CCI very powerfully up here. And guess what? This is going vertical here. As we cashed it out, there was news that then a big investor was coming in to shake up the company, add board seats, whatever. You think anybody knew about that? Yeah, of course. The institutions, some of them will know about this and want to get a piece of that in advance of that news hitting and make some money too. And we're not saying we have that inside knowledge. We don't. But we pick up on these buying patterns that show you that persistent buying, or in this case, selling interest. Here's Alibaba on the downside. So Bob is starting to break down. This is a prior period, obviously. Basically, I'm like, stock's 160. I got to buy a 140 strike put. Even I'm like, that's 10% of the money. Better get moving quick. Next day, it's down 5 points. We get a double in 24 hours. But then if it starts to reverse, I'm not shy about bailing, especially on puts. They've got to move down quick for me to stay with them. We bailed that second piece at 69% gain. Same thing with US Steel. We got the breakdown here on the downside. Everything's all systems go. Notice the negative directional movement over the positive on the ADX on that top panel as ADX rises here. ADX rising just means it's trending. The negative shows you we're actually downtrending, especially as we confirm here. We get bearish right into that next open, and we ride it down for that first double and then sell it out for the rest in 8 trading days. Get testimonials like Robert Arsham. His total portfolio almost tripled when he started using the big trends method. He had more doubles and triples than he'd ever had in his past trading. And it's fun when you get that. And of course, now he uses them as his primary trigger for all of his trades. Surprise! That's what happens when you see how powerful this stuff is. Even GM coming off the pandemic low here in April. This was actually late March. Said, look, this is a retest, just like the Zoom one I showed you. And we were flat for the first 2 or 3 days here. And then by the 5th day, we were making a little bit of money. But I said, you know what? It's too slow. I should have doubled my money by now. I'll take the 50% gain and move on. So some of these keys to being successful as a Grand Slam options trader. And again, this is for the aggressive part of your portfolio. I'm not advocating you load all your portfolio into this stuff. I'm saying try it on a small basis and then gradually build up. But one of the big things is capital allocation. We'll get to in a minute. You got to have the catalysts and the indicators all coming together. I prefer them to really come together either well in front of earnings or now after this earnings season that we're getting under our belt and getting ready for what usually a very powerful November, December, January period here, but maybe with some election tinged volatility. Will it be like 2000, the Bush Gore? Who knows? But the point being, be flexible, take advantage of what the market gives you on the way up or the way down. Time stop at 5 days has saved us so many times. And this is the other piece I didn't talk about yet. Don't overcommit your capital on any one trade. The money put aside to trade the service, ultimately, we say take 5 to 10% of it going into each new trade. Even if we only have 2 or 3 open positions, don't overcommit your capital. Cash is fine to have, and we get our leverage from the options. I also give you weekly video training, so it's really powerful stuff here, folks. So, like I said, if you came in late, this is a $10,000 portfolio, went up to $33,500. That'd be a $23,500 profit. Going back to 2017 to now, this is before commissions. Commissions have come down to next to nothing. This service can also be auto traded if you're afraid of missing the signals. You can call our 800 Big Trends number to get more information on auto trade. But what usually the best I'll do on a 1 month offer here is $147. But you know what? As Dave's been so good to me, I want to give you a way to get it started for just $47. Try the first 30 days with another $100 off. I've already taken it off in this cart here when you go to members.bigtrends.com/slam. Notice it's members.bigtrends.com, not www. Members.bigtrends.com/slam. And what you'll see is not a fancy bunch of words. You'll see a simple way to get started here. So what I want to just remind you of what you're getting here, a 30-day access. You'll get typically about 8 trades over any 30-day period, give or take. And most importantly, you'll get us guiding you through when to hold them, when to bail out of them, when to get ready for the next trade. So try the first 30 days for $47. If you like it, it will auto bill at the usual $147 rate after 30 days. If you don't like it, I'll show you here on this page when you go there. We are taking the coupon code. Try for the first 30 days, $47. Auto bills at the usual $147 rate after 30 days and thereafter. Now, when you get your information in here, you can just say you saw with me here on this webinar. But what I want to point out is that in the terms and conditions below, we even have broken out those terms and conditions page to say, look, it is an auto renewal program. We found this works really well for our subscribers to say, hey, you like it, you want to stay with it, it's just going to auto bill every 30 days. It's really simple. You don't like it, we give you the clear cancel policy instructions as well there that we've broken out for you too. So we're not hiding anything. It's very clear. You can see you're saving a bunch of money off the usual monthly rate of $299. Try it for 30 days for just $47. People always ask me, hey, how about a free trial? Guess what? Free trials are worth what you pay for them, which is nothing. You won't follow it if you don't give yourself just a little bit of skin in the game to say it's worth your time to watch this because you invested $47 on the front end to try it out. Click the terms and condition box, submit order. But if you want to get text alerts, also let me remind you here, you can say text me the alerts at this number here. Okay, so text alerts, whatever your number is, type in what provider you use, and we're good to add you to the text alert list. Just make sure you have unlimited text. I'm at my limit here. I've got to make room for our next speaker. Go to that members.bigtrends.com/slam page. Try it for $47 for the next 30 days. I think you'll find it'll position you really well for the election and for what's to come in 2021. Thanks for having me, Dave. I'll hand it back to you.